The broadcast is now starting. All attendees are in listen-only mode.
Alrighty, hello, good afternoon or good morning, depending on where everyone's calling from. Hope everyone's day is going well. Thank you for joining us for today's webinar. It is the 2018 Exit Planning Summit Insight webinar. My name is Drew English. I'm the program coordinator here at the Exit Planning Institute, and I am with Laura Malone today, who's our speaker, and she is the vice president at the American Endowment Foundation. Before I turn it over to Laura today, just a few brief things I want to hit on, then I'll give an intro to her as well. So a few housekeeping notes is one, the webinar is being recorded. I will send out the recording later today. So look for an email from myself with the downloadable link and go ahead and download that recording for future reference. Number two is the question box. If you have questions or comments throughout the presentation here today, please go ahead and type those in the question box. I'll then moderate those over to Laura at the end of the presentation. So with that, a brief intro about Laura. Laura, being the vice president at the American Endowment Foundation, she has consulted hundreds of trusted advisors, families, and business owners about donor-advised funds and other charitable giving strategies. She's been published in various local and national publications, as well as speaks both locally and nationally to various financial, tax, and estate planning organizations and Exit Planning Institute. Laura is one of our faculty members for the SEPA program, and she usually speaks on the charitable intent and charitable giving session of the SEPA program. So with that, I'll go ahead and give it over to Laura here. She's also going to be a sponsor for us at our Exit Planning Summit, which is in Nashville, September 24th and 25th. If you're looking for additional information on that, you can go to exitplanningconference.com or give our EPI global headquarters here a call, and I'd be more than happy to point you in the right direction and get you the right information. But with that, Laura, I'll turn it over to you, and we'll get going in today's presentation.
Thank you so much, Drew, and thank you everyone for taking the time to be present for this. I'm looking forward to sharing with you a little bit about the business value of charitable values, enhancing business and advisor bottom line. Oftentimes when I speak related to the SEPA program, I do speak at significant length about charitable planning as an exit planning strategy. Since this is a shorter session, I did want to hone in a little bit more about donor advised funds in particular, which is where AEF's sweet spot is in the business exit and business charitable giving strategies, as well as the idea of where this benefits both the businesses as they're running the business from a value acceleration standpoint, and also the advisors. And a lot of this is going to be coming from some newer data that has come from some great research that I enjoy, predominantly coming through U.S. Trust, as some of their data that they do in partnership with Indiana University and their school in philanthropy, as well as the Philanthropic Initiative, which is out of the Boston Community Foundation. Quickly, by way of background, with American Endowment Foundation, we were founded in 1993. We actually just turned 25 a couple of weeks ago. We have over $2 billion in charitable assets, and that is spread across over 5,500 donor-advised fund accounts. We are the largest national independent donor-advised fund in the country. And what I mean by that is we are not affiliated with any for-profit financial institution or other charity. So more often than not, you'll see community foundations have their own donor-advised fund program. You'll see universities are growing to create their own donor-advised fund programs. And most prevalently, you'll see them being created by the financial institutions, most notably Fidelity, Schwab, and Vanguard as the largest financial institutions that have created their own donor-advised funds. Part of what makes us unique is that we do not have those affiliations. We are completely independent and agnostic, which means that we can allow the financial advisor or the donor to have those charitable assets placed on any investment platform that they feel best meets their needs. Our donor experience with donor advised funds is one of the longest in the industry. One of our principal founders had originally come out of the donor advised fund program with the Cleveland Foundation. And the Cleveland Foundation was one of the early adopters of donor advised funds, and the Cleveland Foundation was also one of the first community foundations ever created. So we've had a long history within this space and have seen a lot of change in the last 25 years. As we go through some of the basics of donor advised funds, I just want to point out the general scenario as it plays out in AEF. And I want to point this out simply because this can be a little bit different and a little bit unique depending on what the donors or their financial advisors or their CPAs or their attorneys may be accustomed to. In our case, as I mentioned earlier, AEF is completely independent, and because of that, those assets can sit on any investment platform. So typically the way this situation works is the donor may make a gift to American Endowment Foundation. When they are filling out their AEF paperwork, they are requesting that AEF hire the donor's preferred financial advisor. So what that means is we become an investment client of Bob Smith Advisor. So if you have Don Donor, who's making the charitable contribution, he's filling out the paperwork with AEF, and AEF hires Bob Smith Advisor to custody and manage those charitable assets. What that means most prevalently is there is no pooled environment. All of the donor advised funds are completely separately managed investment accounts that are held by and controlled by the donor's financial advisor as the investment advisor of record. When the donor is ready to make grants out of their donor advised fund, they submit the grant request to American Endowment Foundation. American Endowment Foundation approves that grant request, reaches out to the financial advisor to request the financial liquidity that we need out of the investment account to fulfill that grant request, and then makes that grant recommendation to the donor's favorite charity of choice. And I want to hone in on this a little bit because this is going to dovetail a little bit later into our presentation about the value we're talking about as it relates to the value of the advisor, because there's a lot of business benefit that goes into advisors, not just in this case with the custody and management of the assets, but also in being more proactive and more engaged in that philanthropic conversation to begin with. Quickly to recap the assets that can be contributed, cash and marketable securities are definitely the most prevalent, but we do see a large amount, in fact 90% of the work that I do is in the space of illiquid assets. Gifting of closely held stock, C Corps, S Corps, LLCs, limited partnerships, gifting of residential or commercial real estate. Sometimes we've had personal property, mineral rights, other collectibles. I had a call not too long ago about a violin collection that somebody wanted to donate. We've seen gifts of insurance policies, either existing insurance policies or the creation of new insurance policies to fulfill the donor's charitable intent for after they're gone. Last but not least, we've also seen a lot of activity in the gifting of assets that may create income for the beneficiary. So the 401k plans, the IRA plans, the SEP plans, the profit sharing plans, any of those types of assets. As you know, the charitable tax benefits can be multifaceted, not just the income tax deduction, which is typically what you see with charitable gifts, but most predominantly when you're gifting assets other than cash, you have the additional benefits of the avoidance of capital gains. And that can be significant, especially when you're looking at high growth assets that are non-cash, non-liquid. Predominantly, we see the most amount of growth in this capital gains avoidance in closely held stock and real estate. Also, it is quite common within marketable securities, especially in the instances where marketable securities may be going through a forced capitalization event, where company A is buying out company B. That can be an area of capital gains exposure that your donor's not always immediately aware that they're going to be facing until it's too late. Once again, these gifts are removed from the client's estate. Therefore, they're free from a gift and estate tax. Any of the assets invested in the donor advised fund grow tax-free because AEF is a nonprofit. Any of our investment growth is non-taxable. donor advised funds are a little unique, a little bit different from private foundations in the sense that we don't even have excise tax. So all of it is absolutely 100% tax-free at this point for any of the appreciation of the growth of investments in the donor advised fund. Also, too, if subject to AMT, the contribution will reduce the client's AMT impact for their tax returns. I wanted to hone in quickly on business owners, and this is some great information that came from U.S. Trust and their Wealth and Worth survey that is talking about how folks make their charitable decisions. And a lot of this is among the different generations. You see here the millennials, the Gen X, the boomers, and the silent generation, how often those conversations are made by men, how often those are made by women, or how often those are done equally in the relationship. But I think it's important to note, too, the importance of their volunteer activity and not just their charitable financial contributions, because a large number of the business owners that you see in this space are not only giving their treasure, they're also giving their time and their talents. So that's an important thing to recognize as a professional advisor as to what questions you ask, not just about how they contribute dollars, but also how they contribute time and their talents, or how they encourage their employees to contribute their time and their talents. And I think it's important to note that on the far right side, you can see how this dovetails specifically among business owners and not just across the different generations, and how that mindset is a little bit different, a little bit of an amalgamation of the different generations based upon their mindset as business owners. We see more and more business owners are looking for a way to create a giving culture. And this is more data from U.S. Trust Wealth and Worth study that talks about the idea that a number of these business owners, whether they be small companies or mid-size or large companies, are donating money to one or more charitable organizations. They're encouraging employees to volunteer their time in their community. They may be making in-kind donations of materials, supplies, and space. They may have a trust or a foundation or a donor advised fund, as we're seeing more and more prevalently, that is spearheading their philanthropic efforts as a company. And they also tend to set aside a percentage of company profits that are given to charity. And as I indicated in the past in some of the discussions I've done in the SEPA presentation, I think an important thing to note here is those small to mid-sized companies do tend, when they give, to give a larger percentage of their profits than their larger corporate counterparts. Statistically, on a national level, large corporate giving tends to be about 1 to 1.5%, whereas studies have shown that the middle market companies tend to be giving on average 3% of their profits. And I think a lot of that is that they tend to have more hands-on engagement in the areas that they're distributing their philanthropy, so they feel like they have more skin in the game, being right there front and center in front of everybody in those circumstances. And what does this mean in regards to a value add to the company? What we see more and more, and this is a survey that was done by America's Charities. America's Charities runs a corporate giving program similar to United Way, where the employees can make payroll deductions, and then America's Charities helps to distribute those payroll deductions to the employees' charities of choice. And what we're seeing more and more is employees want to know that the companies have a give back culture in order for them to work for that company. They're looking at the employer mission and values and how they align with their personal values. They're looking for a corporate culture that supports giving and volunteering, much like the business owners are trying to create a corporate culture that supports giving and volunteering. The senior leaders are genuinely involved. It's not just giving at a distance, it's walking the talk. They're also looking for opportunities to use philanthropy to connect with coworkers and also to effectively communicate the impact of the social responsibility that the corporate philanthropy is achieving. And where this ends up providing value is in some other data by a group called Project ROI that is talking about the philanthropic ROI. And what we're talking about here is the idea that the corporate responsibility assets. So anything that the corporation is doing from a give back standpoint that's showing their corporate responsibility as an organization in the social sector can support returns related to increased market value, can support increased sales revenue, can increase customer commitment in their core segments as well as their total segments, and can reduce the company's staff turnover by up to 50%. Now, what we're talking about here is not just giving for giving's sake, it's that fully integrated function of giving, like we were talking about, not just the employee engagement, but looking at how the company walks the talk. How do they blend this into their corporate philosophies? If you think about their giving, if you think about their corporate responsibility, if you think about the business being its own head and heart, how is that giving aligning itself with its own head and heart? Another thing that's interesting that has been pointed out before in EPI's owner readiness report is that internal sellers tend to be 4 times more philanthropic. We've seen this often anecdotally within AEF in regards to business owners that are selling to ESOPs or business owners that are selling to family members, that they tend to be a large portion of the segment that we see that are contributing some of their business interests ahead of that business liquidity event or ahead of that transfer into the ESOP or the transfer to the other family members. So this is really part of the emboldened culture of the owners and what they want to do from a business standpoint as well as a give back standpoint. And we're seeing more and more studies showing that that is creating its own ROI, its own return on investment that can increase the bottom line for the business and help the business along the way. Going back to the idea of where this benefits advisors is first and foremost, I'd say your clients are expecting this. If you look at some of the research from U.S. Trust and their study of the philanthropic conversation, and this is a joint survey done with the Philanthropic Initiative out of Boston, you'll see that their professional advisors, such as their wealth advisor, their tax attorney, their tax advisor, and their financial planners, are second behind their spouse or partner in regards to where they go to seek giving advice. They come ahead of the nonprofits predominantly because the individuals feel like they will get unbiased advice from the professional advisors, from the folks like you that are on this call that are dealing in that financial or wealth space, as well as the legal or tax side of servicing your business owner clients. And that's why this ends up being such a large margin. 1/3 of high net worth consumers expect their advisors to discuss philanthropy. In an earlier study that U.S. Trust had done, they also indicated that 1/3 of high net worth consumers would leave their advisor and go to another advisor that was more proactive in having these conversations. And this is actually proving itself out more and more in this survey as it's been done over the years. The wealth advisors, the trust attorneys, the estate planning attorneys, and the accountants have been adding to the fact that they feel like they are getting a business benefit out of these conversations. First and foremost, they feel like it helps give them a more holistic approach to these discussions. It helps get better insights on how to serve their clients by having deeper personal conversations. It helps them shift their image to the fact that they're not all about the money, that there's a meaning behind what they're trying to achieve with this. And a lot of clients are gravitating especially to those advisors that are more proactively talking about their own giving that they're doing and their own charitable passions. So as you can see, the statistics between the 5-year study 5 years ago in 2013 and then in 2018 have gone up in the sense of the number of advisors that feel like there is definitely a business advantage to having these conversations. Furthermore, they have felt that this has helped them build new clients. And I think a lot of this goes with the bird of a feather analogy, that a lot of the clients that are in this space hang out with friends and cohorts that have these similar passions around philanthropy, and that can become a great gateway to the professional advisors in helping them build a broader base within where they're seeing positive results out of this. And while you will see that the 2013 to 2018 number in that yellow set of bars of deepening the relationships on an aggregate has gone down slightly, you will see on the right-hand side that when you split them out by each individual party, each of these groups, the wealth advisors definitely by the largest margin, but also the trust attorneys and the tax attorneys and the tax advisors are really seeing a benefit in how this is helping them establish new relationships and deepen those relationships with their clients. And I'd say anecdotally in the conversations AEF has had with their advisors, we've definitely seen this prove out. Another way we've seen this prove out is helping them build relationships with the extended family. Because this is a non-financial scenario, this is often a case where that discussion of wealth and values helps to bring in the additional family members, maybe the spouse that never comes to the meeting, or maybe the kids or the grandkids, where they can use this philanthropy as a gateway to build those relationships and stem the attrition of that client loss that can happen once the primary wealth holder dies and the spouse or the kids down the line move that business to the other advisors that they've been working with the whole time in the background. So this has been a great way that advisors have seen them mitigate that client loss that can happen during those familial shifts. And I think this has been proven out not just in this study, but in some of the things we've seen within AEF. I want to quickly, in the time that we have remaining, go over a couple different scenarios. These are migrating a little bit more to those exit planning discussions that we typically talk about. One of the things I wanted to point out here within this case study was the idea of how quickly these transactions can take place. More often than not, we're seeing that the gift is made in the letter of intent stage. While it can potentially be made in the letter of intent stage, it definitely has to be made before the donor enters into a purchase and sale agreement. And even in the letter of intent stage, I'd strongly advise that you engage the client's CPA and attorney in that discussion to make sure that they agree, because more often than not, we have seen scenarios where the legal and tax professionals feel like the LOI may be too late. So the donor came to us on day 35 of the letter of intent. On day 59, we started to review the purchase agreement. Day 64 was when they actually assigned those interests over to us. We received those interests the following day. And then the day after that, literally 3 days later, we entered into the sale agreement to sell those interests to the purchaser. And then that gift or that sale was finalized, and those proceeds were received about 40 days later on day 103. So this can be very quick moving, but I think it's very important to have those discussions in that day 35 stage, even before the LOI if possible, to make sure that all the appropriate I's are dotted and T's are crossed in these scenarios. Another great example that we've seen is sometimes this can't pull together before the sale. Sometimes the best case is the gift after the sale, and there's a lot of different ways to work around that. But in this case, we had a serial entrepreneur that while it didn't work out the first time, it definitely worked the second time. And this was a unique scenario where the buyer walked away for about 3 years. So we were left holding this stock for about 3 years in the donor advised fund when the buyer first walked away at the end of 2015, beginning of 2016. And they recently just resurfaced, and that deal was recently consummated. So that initial gift went from a $3 million gift to a $10 million gift based upon that time horizon that had changed in this set of circumstances. Another case is sometimes the best thing to give may be the limited partnership and when there's a liquidity event of the underlying assets. In this case, this was not a business sale as much as it was the gentleman owned a number of hotels that were all wrapped in independent limited partnerships, and 2 of those hotels were getting ready to sell. He wanted to donate those limited partnerships in advance of the sale of those hotels. So in this case, he went ahead and he made those gifts on May 20th. We signed a consent to sell on June 8th. The proceeds were funded at the end of last year. And at this point, we are waiting for their tax professionals to finally dissolve those limited partnership interests after those assets have been liquidated. Another scenario that we've had is really not so much with the business founder, but with the business widow. And this was a set of circumstances where the founder passed away. The founder's daughter took over control of the company. The widow still had a number of interests in the company that she was redeeming back to the company on an annual basis. This also does happen to be an ESOP, so they have annual buyback windows for all of their shareholders that she typically participates in. She'll normally donate us 1 share of stock for every 3 she plans to redeem as a capital gains offset for the other 3 shares. So she'll use this as a way to mitigate some of that capital gains exposure as the company continues to grow and as the value of these shares continue to grow. And then we typically redeem those back to the company in the following year. So even when it's not part of the founder's exit strategy, it could become part of the exit strategy of other family members that may be affiliated with the founder. And I think that's also a good thing to keep in mind. Lastly, one of our final case studies is this was actually a key employee in retirement. And once again, kind of like the previous case, this was more of a corporate buyback. You know, the company wasn't selling as much as she was exiting the company. She was retiring. She had a significant amount of stock that she had in the company, being one of the early employees with considerable growth in the company through the years. So she gifted the shares on June 2nd. AEF redeemed those shares on June 5th. And the wire of the proceeds was received on June 19th. The appraisal was completed the following February. The appraisal is pivotal for these types of gifts. It does not necessarily need to be made before the gift, but it does need to be made between the date of the gift and the first tax filing for that tax year. So as you can see in this case, the gift was made in June. The appraisal was done in February in advance of the tax filing for the 2017 tax year. I think one of the best things I love about this story was when the wire hit the donor advised fund. This quote below was a quote that actually came from the donor when she got the information from the CFO saying that he had funded the donor advised fund. So Yahoo, do good, have fun, donate money. It's actually something I have on my wall because I was so tickled by that expression. It was just so joyous when it came through that it's something that helps me get through my day. As we go to wrap up, I just want to bring to mind ways that you can look at this with your current book of business. Think about what you know about your current clients. Are they charitably minded? Do they have liquid assets? Do they, even if they have marketable securities? Anything is better than giving cash. And for those of you that operate in a tax environment, you know that. Have you had a conversation about how to help them increase their giving through more tax efficient strategies? It amazes me when we talk to advisors how often clients are never asked that question. Are they facing a high income year or a major liquidity event? And also too, as the advisors have proven out in the studies we shared about how it benefits their business, keep in mind the personal, not just the financial. While there are tax benefits to a lot of this, a lot of the biggest power behind all of this is really being able to go into some of the personal meaning, the personal benefit, the personal gain they're going to get from a feel-good standpoint, not just the tax side. I want to thank you guys. I'm happy to take any questions, Drew, if we have anything that's come up from the group, and thank you again for your time.
Awesome. Yes, thank you, Laura. We had one question come in, but if there's additional questions, please go ahead and type those in the question box in your menu there on GoToWebinar. But Laura, talking about the charitable assets, where do you guys usually hold those?
That's a great question, and it's definitely something that can be counterintuitive sometimes for different advisors, depending on the program they're used to. We tend to hire the client's financial advisor. So wherever that financial advisor keeps their assets, we are custodying and managing those assets with that advisor. If the client is with an LPL advisor, they are in an LPL account that are in AEF's name for the client's benefit. If the client is working with a First Republic advisor or a UBS advisor, the assets are held in a First Republic account or a UBS account in AEF's name for the benefit of that client. The money stays wherever the client currently has their assets. It's simply retitled in the name of the charity instead of the name of the client.
Perfect. Thank you. Thank you. And then if there's any additional questions, there's Laura's email address and phone number there on the screen. Please feel free to shoot her any comments or questions, or you can contact us here at the global headquarters as well, and I'd be more than happy to send those over and get those answered for you. But with that, we'll go ahead and start wrapping up the webinar today here. I did just want to re-mention the summit down in Nashville, which is September 24th and 25th. Laura will actually be there as part of our exhibit hall. And so if you have a chance to go there and see Laura and the American Endowment Foundation, I highly recommend it. She is a SEPA and part of our faculty as well, so she has a wealth of knowledge that hopefully could be shared more in depth as well. But with that, we'll go ahead and conclude. Laura, thank you very, very much for spending some time with us today. Greatly appreciate it. And if there's any additional questions, please feel free to reach out to her or myself here, and we'll get those answered for you. But with that, we'll go ahead and conclude. So thank you very much for everyone for attending. Laura, thank you. Have a good rest of the day and a good rest of the week, everybody.
Bye-bye.